Hello again, Maverick Traders. Welcome out to your educational classes. Corey Halliday here with you. And today we're going to look at the 10-year minus the 2-year. This is often talked about in financial circles as a recession indicator. We're going to start by looking at yield curves and differential between shorter term versus longer term. What's normal, what's abnormal, how that speaks to risk and the risks in the market. And I think you'll find this really fascinating, the way that this indicator has actually had a predictive value to recessions. Every recession that's hit has been the precursor to that has been this abnormal yield curve that has gone inverted. So there's some fascinating things here to pay attention to. We will kind of discuss where the markets are at today, which unfortunately is headed towards a recession based on this indicator and probably other factors as well. So let's get to it, and let's start with yield curves a bit. So let's talk about the 2-year versus the 10-year Treasury. This is oftentimes looked at as kind of a recession indicator and so on, and we'll look at that here in a second. But there's something in, I guess we could just keep drawing this out versus a 30-year versus whatever. It's called a yield curve. And what is a normal yield curve? A normal yield curve would be upward sloping. Kind of a steep yield curve, they call it. So if I were to buy a 2-year bond, would I expect more interest to be paid to me or less interest paid to me than a 10-year? And if I was locking my money up for 10-year, would I expect more money than locking it up for 2 years? Yes. Would I expect less than if I locked it up for 30 years? Yes. And so on. Think of it like going and taking out a loan. If you go into a bank and you take out a loan, the bank expects that they can charge more interest the more years they give you the money, right? If you take out a 2-year loan, you're probably paying a smaller amount of interest than if you take out a 10-year loan. And if you take out a 30-year, you pay more interest yet. Similar to mortgages, we would always expect that a 15-year mortgage versus a 30-year mortgage, well, I'm going to pay a higher interest rate to borrow the money for 30 years, right? So the more time equals more money. So that would be normal pricing. Like a 2-year might pay you 1%, a 10-year might pay you 3%, and a 30-year might pay you 5%. That would be the yield curve, and in this case, kind of a steeper yield curve. Sometimes you get a flat yield curve. It's still going upward, but it might be 1% for the 2-year. Let's say 1.5 for the 10-year and 2.5 for the 30-year or something like that. It's still going up, but you can see that it's much flatter. They call that a flat yield curve and so forth. The steeper it goes, the better for banking institutions and financial companies. Financial businesses, if we think about banks, there's a saying that a steep yield curve will make banking geniuses out of banking idiots. What does that mean? Well, if I operate as a bank, a steep yield curve takes care of me. Because where do banks pay? What do they pay? Well, they pay interest on deposits, basically savings accounts, right? So they have to pay interest, but it's saving account interest. And how much does your savings account pay you? Yeah, probably next to nothing. Exactly. So they're paying very little. What do they collect in terms of interest? Well, they collect whatever they can get for mortgages and putting out loans, but long-term loans, right? Long-term loans is basically a lot of what they collect. Now it's not all broken down to this, but this is a big piece of it. So if I can pay someone savings account next to nothing, but I can go out and make a 30-year loan and collect 5%, pay less than 1, I've got a huge margin of profit. My profit margin's quite nice because the difference between 0.05% and 5%, the profit margin is plus 4.5% in my favor as a bank, right? And so that differential there is, I guess this would be 0.5, 0.5%. 4.5% differential, right? So very nice. That's a nice profit margin. A flat yield curve creates more of a problem because it's just not generating that much. Again, it might be 0.5, but now my long-term loans are only 2.5. My profit margin's down to 2. Here I have a 4.5% return. Here I have a 2% return as a bank, not as much. So in terms of the yield curve, banks actually want long-term interest rates to be higher. That's more valuable. They want a big differential there, right? So if this is 0.5, let's say that they pay on the savings accounts, the difference being 4.5 or being 2.5 versus 0.5 is 2%. That's over 2 times more profit. And that's their net interest margin is what they call it. So in terms of this, kind of expectation and differential and so on, yeah, I switched it. I called this 0.5%. So sorry to confuse you. I started with 0.05 and then I changed it. I said, let's go ahead and bump it up to 0.5%. So that's your difference. Now, if we look at this from the standpoint of kind of, expectations and whatnot and how this plays out, there's even a scenario where this can go like this. Now it's pretty weird, it's pretty strange, but basically a 2-year could be at 3%, a 10-year could be at 2.5, and I don't know, maybe the 30-year is back up to maybe it's 3. We would have to slope that back up this way. Maybe it's at 3.5 or something like that. This would probably be more accurate to how it generally looks. It would kind of be like that. And basically what they call this is an inverted yield curve. It's usually not backwards all the way through. It would be pretty rare for the 2-year to be paying way more interest than a 30-year, but it's not that rare for a 2-year to be paying more than a 10-year. It's not super common, and this is kind of when you get into futures and you talk about backwardation versus contango. That's basically what an inverted yield curve is. It's backwardation. And so remember, in the futures markets, when futures pricing gets backward, they call it backwardation. That means that prices in the front month are more expensive than later on. That's kind of what's happening here. And we always say that's an abnormality. That's abnormal to how it should be. Well, an inverted yield curve is abnormal to how it should be. Why on earth would I be paying less or getting paid less to lend my money to someone at 10 years than what I can collect to lend it to them for 2 years? I would expect to be compensated more for giving them my money for that much extra. I'm going to give them my money for 8 more years, and they're going to pay me less interest than if I give it to them for 2 years. It's backwards. Something's out of whack. Something's abnormal. And it kind of speaks to, again, that there's something in the system that's just not quite right. And it's usually, a matter of risk. That something is a bit out of whack. So you can even download these reports and this data on your smartphone. If you went in like on your Apple device and you went into the App Store, you'd actually be able to download what they call the FRED, the St. Louis Fed, and pull up all of these things. I'm on a desktop. If I just do a Google search for 2 to 10 year curve, you can see fred.stlouisfed.org, and it's going to show the 10-year constant maturity minus the 2-year. If I click on that, it's going to bring me into the chart, which is what we're talking about today. So what they're doing is they're taking a 10-year yield and subtracting the 2-year and showing the differential. Let's look at this chart. So see the stlouisfed.org. This is where you can get a lot of different reports. If you want to go look up GDP reports, if you want to look up M2 money supply, I mean, anything you can think of. This is the Fed database, the St. Louis Fed. So see how they call it the FRED there. Now, look at this chart, and what do you see? So here's the 0%. The 10-year Treasury constant maturity minus the 2-year. On occasion, it will dip below 0. And that's basically your backwardation, aka your inverted curve. That means that the 2-year interest is now higher than the 10-year. And it's a bit of a warning shot. You know, you've heard the saying, the shot across the bow. It's not something that means you're in a recession today. It means that something's out of whack, and the market kind of senses that that's the case. And usually the recession hits about a year later. It's kind of a leading indicator, we would call it. And the history on this is pretty impressive, actually. So look at this chart and you say, okay, it went inverted where? Well, back here in 2019. It went inverted, and where did we hit a recession? Remember, your shaded area is a recession. We hit a recession in 2020. Now, you could say, well, how did this predict COVID and that recession? I don't know, but it did about little under a year before it happened. What's happening right now? We have a massive inversion of the yield curve. 2-year yields paying a high interest compared to 10-year. People are nervous, a little, nervous about this. Does this suggest, and by the way, it kind of peaked right there a couple of months prior, it inverted temporarily. Does this suggest that we're going to see a shaded area coming up, aka a recession? That we'll go into a full-blown recession, that it'll show the shaded area on the chart? Yeah, I mean, that's the indication, is that we're approaching an economic recession, that one is coming. And usually it hits somewhere around a year later, okay? You can take this chart back and you can look at it through history. You can say, okay, well, there's 2020, but let's go back further. There were no recessions in 1918, but we know there was one in 2008. We know there was one in 2000. And so on. And so if you just come back, well, let's go back. Heck, let's go back as far as this chart goes. Why not? Okay, check this out. Here's the entirety of the chart, but here's the 08, the financial crisis. Look at what happened. See the yield curve inversion, see how we dipped below 1, and then the recession hit later. Okay, before the tech bubble burst and whatnot, and we hit the actual recession, the inverted yield curve was kind of a leading warning to that. Back in the 90s, we had a recession. We had the inverted yield curve just prior to that. Back here in the 80s, we had a couple of recessions, and of course, we had the inverted yield curves just prior to that, and so on. Notice that through the entirety of the 2000s, we never had that inverted yield curve. The only time it hit was right before the recession in 2020. So, you can look at this and kind of say, well, is all of that coincidental? Did it just so happen? that you had the inverted yield curve just prior? Well, maybe, but I think there's probably a stronger indication that markets, remember, they're based on supply and demand, and they're based on the movement of capital and so on. And if you're looking at the data, it'll kind of show you when risk is increasing, when things are a little bit out of whack, when prices are not acting normal. And that's basically what this entails is, hey, there's something going on in the financial markets that's out of whack. And people that are paying attention to it kind of see the writing on the wall. It's part of, why were we kind of saying, hey, 2022 is going to be a rough year and the market's going to be in a tougher spot and so on. Well, part of it is this type of data. Part of it is quantitative tightening. The fact that the Fed, with inflation running high, the Fed has to reduce their balance sheet. Remember what the Fed is doing right now is allowing, so a big part of what the Fed was doing for many, many years is buying bonds. And the reason that they would buy bonds is what? Well, if they buy bonds, it drives down rates. Rates go down, which spurs on the economy, right? So if you pay more for bonds, the rates go down. It's supply and demand. The more people want to buy bonds, the lower the rates become. Because there's so much demand for it. So, and it kind of competes against each other. Oh, Apple gets to pay 2% because they're such an enormous great company. Well, then that means that if Amazon and Google and these other great companies go and sell bonds, they're going to be around 2% and so on. And the more buyers you have for these bonds, the lower the rates they get to sell, right? So the Fed was in there buying bonds, and the Fed now has a balance sheet that's at $9 trillion. That's a lot of capital. What the Fed is now doing, remember, bonds have a maturity date. So they've purchased all these bonds, trillions of them, trillions of dollars worth. And when these bonds hit maturity, the money gets paid back. So theoretically, the Fed is getting paid interest from the bonds, and then they get their money back at maturity. Most of what the Fed has been buying is their own debt. It's kind of a little Ponzi scheme. They're paying interest to themselves, and then they pay themselves back the money. But any way you slice it, they're buying U.S. government bonds and different things like that. When it hits maturity, what they were doing before was rolling it back into new bonds. When it would hit maturity and they'd be paid a billion dollars, they would go buy $1 billion worth of new bonds, and they'd keep rolling that money forward. Now, when the bond hits maturity, they're not doing that. They're in quantitative tightening mode. So it hits maturity, they retire that money. So this balance sheet is shrinking, which is a good thing. This is good news, by the way. They're not perpetuating the Ponzi further. They're not rolling it into new bonds and so on. And I don't know if you should call it a Ponzi, but it's financial product manipulation. When you manipulate, if you go out and manipulate financial products, you're breaking the law. If you go try to do things that basically are a hoax to drive prices and control prices and so on, you can go to jail for that stuff. But the Fed gets to do it for free. That it's legal for them. Good enough for you, but not for me, type of thing. It's kind of like how politicians, it's always the problem I have with politicians. Hey, these are good laws for all of you. We'll live by a different standard, but you guys should live like this. But anyway, off the soapbox. So the bonds hit maturity. Now they're not rolling them into new bonds. Well, what does that mean? There's fewer buyers for bonds. And so if there's fewer buyers for bonds, rates are now going up, right? Fewer buyers, well, now they have to find buyers. The only way they find more buyers in the market is to pay higher rates to attract more buyers. The biggest buyer is now out of the market. So no surprise that rates are going up. And by the way, Higher rates do what? Well, they slow the economy. They slow things down. The same reason they were trying to reduce rates was to get economic activity going, and they certainly did that during this period of time, right? The markets boomed and we didn't have a recession through there and so on. Well, they can do that. They can influence things in that short term. But now that they're done and inflation is ramped up and they really have to take it serious, it's going to be a struggle. So, do I expect that with this inverted yield curve we have right here, right now, it's a precursor and kind of a warning that we're going to be headed towards a recession? I would say absolutely. We'll leave it there, but again, and looking at the yield curve and looking at what our future holds, we're probably headed towards a recession. Not just because of this indicator, but this is one of a few different factors, quantitative tightening, all of the different influential aspects of raising rates and such. Well, that's part of cause and effect, right? When we have less money in the system, higher interest rates, those sorts of things, it slows down economic activity. You go into economic recessions, and that's perfectly normal. So, a great indicator that you can put in your toolbox as a predictor for future recessions. Hope you enjoyed this class. On behalf of Maverick Trading, I'm Corey Halliday. We'll see you next time. Goodbye, everyone.